One of the coolest things I've ever seen, cooler than this and this, was when the American space technology company SpaceX managed to guide its booster part of its Starship back to Earth in order to be reused again. This is in line with SpaceX's goal of making space travel more affordable. Having both the booster and spacecraft to eventually be reusable could push the cost of transporting a kilogram down even further than previous launch vehicles built by SpaceX. SpaceX now has a dominant position when it comes to transporting stuff into space. And investors think that this is pretty cool as well. SpaceX rockets are not the only thing that's been soaring, but also its valuation. And most of this seems to have been driven by the rosy prospects for Starlink. Starlink is a subsidiary of SpaceX that makes satellites that provides internet access almost anywhere to subscribers. SpaceX is now one of the most highly valued private companies in the world. It's private. That means that the shares of SpaceX are not traded on a stock exchange. So I did a bit of a deep dive into how one invests in a private company like SpaceX. It is possible, but there's a lot of caveats and important things you need to consider. And in this video, I'll go through with what I learned, so let's start. First, it's easier to understand what it means to be a private company if we first compare them to public companies. Now, shares of public companies are traded on stock exchanges, and anyone from Warren Buffett and yourself can invest in these shares. Publicly listed companies has a greater access to capital compared to private ones. But as Uncle Ben once said, Peter, with great access to capital comes great financial disclosure responsibility. Public companies are required to disclose to the public how much they have earned, what assets they own, and other financial information on an ongoing basis. But for private companies, there's no such requirements. Financial information for companies like SpaceX is quite hard to come by, and less transparency generally means more risk. This is why in order to directly invest in private companies like SpaceX, you have to be a so-called accredited investor. Like, this is the kind of classification you put on your Hinge account to stand out from the rest. And you may qualify as an accredited investor by the SEC if you earn or have enough money. The thinking goes that once your financial status reaches these levels, you're able to bear the increased risk when it comes to private companies. So let's say you fall into this category. Hypothetically speaking, you could try to contact and buy SpaceX shares from existing shareholders. Now, even if you find employees that are willing to sell you their shares, actually the SpaceX themselves, the company, needs to prove those transactions first. Now, SpaceX wants to control the number of shareholders for a good reason, because once a company has more than 500 shareholders, the SEC may require the company to do ongoing financial disclosures. So SpaceX doesn't want their employees to spread around shares like it's a Mr. Beast giveaway video.
I just bought 1,000 SpaceX shares that I'm going to be giving them away to random people that subscribe.
Now, there are also websites that provide secondary markets for shares in private companies. And the site will double check your eligibility. It's not like you're clicking yes on a website that's asking if you're 18 or something like that, which I heard some websites do. Now, if you're not an accredited investor, by investing in either public companies or funds that themselves have invested in SpaceX, you can get so-called indirect exposure to SpaceX. One example is Google that invested 900 million in SpaceX in 2015. And according to corporate filings from 2021, Google now owns around 7% of all shares of SpaceX. Now, that's a significant ownership. So should you invest in Google to get exposure to SpaceX? Well, let's run the numbers while I play some gameplay in the background in order to sustain viewer retention.
The latest indicative valuation of SpaceX is 210 billion. Google's 7% ownership means an investment around 14.7 billion. This is small compared to Google's market capitalization. For each dollar invested in Google, just a fraction of a cent goes into SpaceX.
So no, even though the two companies are doing some collaboration, I would not invest in Google if the sole purpose was to get some exposure to SpaceX. The investment is so small compared to the total market cap of Google. You can also put your money in funds that have invested in SpaceX. The fund with the highest allocation to SpaceX I could find was the Destiny Tech 100. The largest holding by far is SpaceX. Now, the good thing is that shares of this fund can easily be bought and sold because they are listed on the New York Stock Exchange. So the fund trades as a stock on a public exchange, while the underlying assets are illiquid private companies. So it's quite an interesting structure if you think about it. So have we now found a great way to get exposure to SpaceX? Remember when we estimated how much SpaceX exposure you can get from $1 in Google? So we can kind of do the same analysis here if we take a closer look. Looking at the fund's portfolio, we can see that they have more than $56 million in private assets and cash. The fund also has some liabilities that we will subtract, leaving almost exactly $56 million. This is the so-called net asset value of the fund. Fancy word for summing up the fair value of the assets and subtracting the liabilities. Dividing our total net asset value of the fund with the number of fund shares, we get $5.15. One share of this fund, it's going to represent $5.15 of net asset value. Now remember that these shares can be traded on an exchange. So what would you pay for this? Would you round it up and pay $5.5? $6? Actually, you have to pay a lot more.
Days after the US election, Destiny Tech 100 had skyrocketed. Fund now trades at $36.2 a share, meaning a 600% premium above the net asset value per share we calculated earlier.
Actually, Destiny Tech 100 has the highest premium of all so-called closed-end funds in the US. So you need to pay quite a lot in order to buy $1 of private company equity here. And another reason against Destiny Tech 100 is its portfolio excluding SpaceX. Looking at changes in fair value of their positions, SpaceX seems to be one of the only companies doing well. So to summarize the Destiny Tech 100, even though the net asset value for private investments are based on past and infrequent transactions and estimations of fair value using uncertain inputs, assuming that net asset value is not completely off, the fund is trading at a huge premium. And even though SpaceX might see its fair value to go up, there's a lot of other positions that is dragging down the portfolio. And the 2.5% annual fee doesn't help. Stack Capital Group is an investment holding company based in Toronto, kind of having the same sales pitch as the Destiny Fund. And it also has SpaceX as its largest holding, representing around 14% of the portfolio. Also in contrast to the Tech 100 fund, this fund is trading currently at a discount to its net asset value. But again, these estimates for what they call fair value for private companies are very uncertain, so take this with a grain of salt. Stack has roughly twice the cash allocation to the Destiny Tech 100 fund. You would rather see that that money is being put into work, into investments, instead of just sitting there while management fees are being withdrawn. Another closed-end fund that holds shares in SpaceX is Ark Venture. If I see another fund talking about democratizing capital markets, I'm gonna lose it. SpaceX is the fund's largest holding, around 13%. The fee, however, is quite high, almost approaching 3%. But the worst part of this fund, in my opinion, is that it is a so-called interval fund. This means that the fund is not traded on a national security exchange, it is unlisted. Instead, the fund will on a quarterly basis only repurchase shares from investors that wants to sell. So this makes the shares very illiquid. Also, it seems that you can only buy fund shares using SoFi. So sure, it's a large allocation to SpaceX, but there is a very high fee and it's very illiquid, so these are some red flags you should be aware of. Lastly, the Barron-focused growth fund has almost 9% of their portfolio in SpaceX. It is the second holding after Tesla. Now, this is a lower allocation to SpaceX than we have seen previously, but SpaceX is the only private investment that the fund has. All the others are in public stock. Meaning that if you already own shares in, let's say, Tesla or Spotify, this fund could be an interesting alternative, since you can get exposure to those stocks while still have some allocation to SpaceX. Now, the 1.32% management fee is a bit on the high end, given the fact that the vast majority of these positions are in public stocks. If you know of any other ways you could invest in SpaceX, just let me know in the comments. Please make sure to like and subscribe if you haven't done so already, and I'll see you later.